Okay, so now we're going to get into a topic that I've taught this subject for a long time and managed a lot of people, in accounting departments and things. And debits and credits, which are the most fundamental part, really are very confusing at first for a lot of people. It's so don't. It's probably going to be for you. It was for me. I know that. It took me a long time to get a handle on it. And even now, sometimes I still have to think for a second about, wait, is that a debit or a credit? Which side of the transaction am I crediting? Which side am I debiting? So this is a topic that you'll wrestle with for a long time, but it's absolutely fundamental. Debits and credits. You probably heard that phrase, and now you're actually going to know what it means. So, and for you that do know it, it's a good review, right? And we all could always use that. So debits and credits, they're the two most basic accounting terms, and you need to become familiar with them. They represent the fundamental concept of bookkeeping. We're talking about double entry bookkeeping, right? However, the practice of double entry bookkeeping and the application of debits and credits to accounts is not intuitive, and it'll take some time to get used to it. So with that in mind, let's discuss the topics in more detail. So here we have a couple of the various entries that you'll come across, right? And we call the way that we sketch out a double entry debit and credit, journal entry, right? A transaction with two sides. We call it a T account because, as you can see here, this sort of forms a T, right? And really, what it is, it's like a mini balance sheet, right? We have a balance sheet, you have the assets on that side, on this side, you have liabilities and equity. In this, you have debit and credit. And debits and credits look a little different on both sides of on either side of the balance sheet, right? For assets, a debit increases, an increase in a debit increases the debit account, and credits decrease the account. So if you paid a check, you cut a check to somebody, then one side of the transaction would be crediting the bank account, right? That's an asset, and you've reduced your cash. So it would credit that side, and it would probably maybe debit, might debit a liability, like you might have had accounts payable, and you paid it, you debited this side for $50, and you credited this cash account, the asset account, for $50. So that's how you would do a journal entry. So let's look at on the assets. On the asset side of the balance sheet, debits increase, credits decrease. On the liability side, a debit to a liability decreases that liability, right? And a credit to a liability account increases that liability. So then we also have owner's equity, right? That's the other account on the liabilities and owner's equity. And so the same thing as liability accounts. It's on the other side of the balance sheet, right? A debit decreases it, credit increases it. Now, the income statement acts the same way as the owner's equity account, because when you think about it, and this took me a long time to understand, the income statement is basically, it's a temporary account, right? Temporary account gets wiped out at the end of when you close out the accounts, when you make your financial statements, right? Say the end of the year. And then you start with revenue and expenses at zero again for the following period, for the year, whatever. So that it acts, the income statement accounts, revenue and expense accounts act like owner's equity, because they are embedded, basically, temporary accounts embedded in the owner's equity section of the balance sheet. So, right, because revenue minus expenses equals net income, and net income at the end of the year, whichever residual of net income, goes into additional paid-in capital, goes into owner's equity, right? So that's it's actually into retained earnings. It's the retained earnings of the corporation is the owner's equity part that is increased each year by the net income. And the net income, sometimes some of it is parsed out as a dividend, right, to the shareholders, and the other part would be put into retained earnings in the owner's equity section. So that's a way to think about why does it look like a liability account. It's not a liability account, it's an owner's equity account. So the same thing, debits decrease revenue, credits increase revenue, debits increase expenses, and credits decrease expenses. And that kind of seems backwards. That's why I'm saying it's not intuitive. But once you get your mind around it, it makes a whole bunch of sense, right? So revenue is really a credit side account, right? Because as you gain revenues, you're gaining credits. You're crediting, when you make sale, you're crediting the revenue account. And then debiting some asset, and crediting some asset account, debiting some asset account on the other side. So debits and credits, let's go through what they are. In accounting, there's two sides to every transaction, right? And they're called the debit and credit. Each journal entry affects at least two accounts. It can affect a group of debits and a group of credits, but they must equal each other. The debits, the sum of all those, the group of debits must equal the group of credits. It has to balance, right? This is a concept that may take a while to get your head around, get used to, but you will, believe me. Think of a situation where you lend somebody $10. Like Shakespeare said, neither a borrower nor lender be, right? There are two sides to this type of IOU type of transaction, the borrower and the lender. You record that you expect the money back, right? That's an asset. And think about banks this way too. Every bank, that's why banks, there's the concern about, the banking system failing or something, because every asset on one bank is a liability on another bank. And so if the asset value erodes, then suddenly the ability to get paid back goes down, and so everything can fall apart like a cascade, like a house of cards, right? Or dominoes or something. So you record that you expect the money back, that's an asset, and the other party records that they expect to pay it back, that's their liability, right? And so that's how across companies, you can see these transactions, how they operate. All transactions are two-sided like this. One account is enhanced and one is depleted, right? Or think of a deli counter transaction. You get a sandwich and the deli gets money, but each side records two entries, right? From the deli side, they get money and that increases their revenue, and they give up a sandwich, which depletes their inventory, right? So that's their two sides of the transaction on their side. From your side, you get a delicious sandwich, which is an asset, right? So that increases your asset side. You debit an asset account, and you give up money, which credits another asset account, your bank account. So each side records a double entry transaction. Each side's transaction entry is a mirror image of the other. What you gain, they give up, and vice versa. So accounting is a zero-sum endeavor. What one side gets, the other side depletes or loses. So think about the sandwich again, right? So a sandwich, and it's an asset, and kind of a joke, right? But you have an asset, but then you say the asset takes 5 bites, and you eat it. Well, then that asset has been expensed, right? And so you would expense it from the asset account into an expense account. That would be the other side of that. And you can think of the sandwich, say, like another asset, say like a piece of equipment in a company. And you're going to use that piece of equipment, say, for 5 years, right? And just like the sandwich would take 5 bites, you would take a bite of that sandwich each year. And so you'd use up 1/5, right? 5 times 1/5 of that asset each year. And that is a way to think about depreciation, right? You take depreciation, it's like a bite of that sandwich. You use 1/5 of that piece of equipment that year, so you subtract 1/5 from it and expense that out. The next year you'd use another 1/5 and you'd expense that out until after 5/5 the asset is worth 0 and you've expensed it 1/5 each year for 5 years. So you can kind of think of every asset, a capital asset like that, when you depreciate it, as like taking a bite out of a sandwich, right? So just to give you another analogy of how these things work. So now I'm going to talk about debits and credits in 2 separate slides. So, these are tricky concepts to understand, and here's another trying to make a simplified explanation. So a debit increases the resources of the enterprise, and a credit reduces the resources. You think about this for your personal life too, right? Our personal lives are run kind of like an enterprise as far as we get money and we spend money. And we buy things and we use them over time, all that. So with asset accounts, ones that are resources, right, a debit will increase the account. With a liability account, ones that are obligations of the enterprise, a debit will decrease that account because the decrease of a liability, like a loan, means in essence that you're increasing the resources of a company, right? Of the company. So, think about this like if you pay off a credit card. If you pay off a credit card, you've increased your resources, right? Because you're no longer carrying that obligation, that debt. And and you're also saving a ton of interest payments. That's why a lot of times I say, in personal finance, if you want to make, say, 20% on your money, and people go, oh, wow, how can I make 20% on my money? Well, pay off your credit card debt because you're paying like 20% interest on it. And that's a way to guarantee make 20% on that investment. And then people get all disappointed because I wanted to have an investment that was going to guarantee making me 20%, not something I have to pay off. But that's the best way to start to get financially solvent is pay off those credit cards. And so that's the debit side, right? And here's the credit side. Credits are the mirror image, right? The mirror image opposite. When you pay a bill, you credit cash, right? If you pay a bill, cash is an asset account. It's at the top of the balance sheet. It's the most liquid, right? And because you've reduced the amount of cash you have, when you pay a bill, you're paying with money, you reduce that account. So you're crediting that asset account. If you take out a loan, you credit the loan account, right? A liability account, and that increases that loan account, right? Because you've increased an obligation of the company. So you probably have to refer back to these concepts of debit and credits, a number of times throughout, your career here. But this concept, it's challenging, but don't become frustrated. Don't let it become frustrated. And it becomes clear with use. And it's a brilliant, brilliant system, and it really works. And it's worked for 800 years or so, which is pretty incredible. So there you have about 700 years, actually, I guess. So there you have it with debits and credits. Keep in mind that now you kind of understand what they are, but it'll take a long time for that to sink in, maybe. But and maybe not. Maybe this was clear enough that you actually understand it now. But that is the crux of accounting and these journal entries and bookkeeping. And if you can understand this, then all the other accounting and finance and financial statement analysis and net present value and valuations in corporate finance, all of those concepts are built on and predicated upon this foundational knowledge. So this is really important, and now you know enough about it to move on and have a concept about where these come, because they're all built on each other, right? And a lot of corporations, the way people go up the corporate ladder, is start out as a bookkeeper, entering these kind of journal entries and all, and then move up to more senior accounting roles, and from senior accounting roles move into the finance department, and from finance maybe move up to be a controller or a CFO, and from CFO maybe become a CEO. So there's a path from this basics all the way up to the top of a corporation, because when you understand these basics, then you really have the foundational knowledge to really understand a company. When you understand this, and then you can read and understand financial statements, you have such a leg up on anyone else that your colleagues, people you're competing with in your career, and you also can really understand companies, and that's great for investing too. Put money in the stock market, you should always look at 10K annual reports and look at their accounting, look at the financial statements, and understand them, and see whether a company is healthy and well run, or if it's has some fragile finances going on. So I hope you like this. It's very beneficial, and I know it's probably not the most exciting of subjects, but it is one of the most powerful of subjects to know in business. So I'll catch you in the next lecture.